And thereafter, we will go into the meat for today, the deep dive into Uganda's resilient banking sector. And then you're going to be able to learn many things. Why are some banks making profits during a period which was referred as tough, while many other banks are struggling? And of course, we also look at what are Uganda's most efficient banks and what ails them. And most importantly, we have looked at the power brands in banking using the same model and the formula as the interbrand. So you're also going to see that maybe asset size may not be a determinant of the most popular or strong brand. So we'll also show you these kind of trends in the banking sector. So thanks very much for joining us. And in line with our motto, for God and my country, I'm going to invite Godfrey Senyonjo to just say a short prayer, and then I will invite our partner, Dison, to make opening remarks. Thank you. Godfrey.
Let's create some souls and we pray. Lord Father, we thank you for this beautiful morning. We thank you for this launch. Lord Father, we pray that, Lord, you give us the wisdom, you give us the understanding. And Lord Father, we pray that you guide us into this launch. We have prayed this first in the name of Jesus Lord.
Thank you, Godfrey. Allow me, members, to invite the CEO of the Institute of Corporate Governance of Uganda, one of our partners in the promotion of good corporate governance practices. It is the Washington Post, which says that democracy dies in darkness. And we couldn't find any better phrase to say that also good governance dies in darkness. So we are trying to throw a light onto the performance of Uganda's banking sector to just create a comparative dimension and cause people to face reality, especially the leaders of the industry and also the national leaders. So ladies and gentlemen, let us virtually join hands and welcome Dison Okumu. So Dison. Okay, this one seems not to be on call, but anytime he comes, we shall have him join us. I will ask my colleague to, yes, this one, are you back? Dison Okumu, our partner, if you are on the call, please say something so that we can start this meeting. Thank you.
Hello? Hello?
Yes, we can hear you.
Yes, I am on now.
Okay, please, the floor is yours, sir. I will unshare my screen so that you can say something. Thank you.
Okay.
Yes, please, this one, talk to us. The floor is yours. Thank you. Unmute. Okay, sure.
Okay, good morning, everybody. On behalf of the Council and the entire membership of the Institute of Corporate Governance of Uganda, I would like to sincerely thank the organizers of this event for inviting us to participate. The Institute of Corporate Governance of Uganda was established in the year 2000 as a non-for-profit membership-based organization with now over 796 individual members and 112 corporates. Our vision is to build an enterprise sector that upholds international best practices in corporate governance in Uganda and the Great Lakes region. The key pillars of corporate governance, according to us, is summarized in the acronym ATTIRE. ATTIRE is an acronym, A standing for accountability, transparency, trust, integrity, responsibility, and excellence. In Uganda today, ladies and gentlemen, matters of poor governance are quite prevalent, as reported both in the mainstream and social media on a daily basis. This manifests itself in various forms, such as conflict of interest, office abuse, receiving bribes and kickback, remuneration fixing, unfaithfulness through absenteeism, cheating, conning, plundering resources of organizations, theft and fraud, influence peddling, over-invoicing, and nepotism. These things I have mentioned, if you read the first letters downwards, constitute what we call corruption. So our strategy as the Institute of Corporate Governance of Uganda, in the quest to achieve our aspirations of propagating and promoting corporate governance principles with the objective of deepening and entrenching its international acceptable practices in Uganda, we have decided to build strategic partnerships with organizations with similar objectives. That's why we are proud to be part of this launch of the 2021 Banking Sector Report, analyzed by our very ardent corporate member, Summit Consulting Group. Our Secretariat has actually extended this invitation to each and every member of the Institute of Corporate Governance of Uganda to attend this launch, and I hope many of them have logged in. Allow me also to take this chance to invite all institutions represented here in the banking sector and indeed from any other sector of the economy to participate in the 2021 Corporate Governance Award exercise, which shall be launched soon. This particular exercise, whose major sponsor is Grant Thornton, will give opportunity to institutions in various sectors of the economy to self-assess their corporate governance compliance level, benchmarked against internationally acceptable best practices. It will then rank participating companies sector by sector and give awards to winners and runners-up in each category. This way, we should be in a position to raise awareness about the importance of corporate governance in our country. ICGU is also now in dialogue with the National Planning Authority, NPA, to jointly institutionalize the measurement and reporting of the status of corporate governance in Uganda on an annual basis under the African peer review mechanism arrangement. I would like to thank you very much. And once again, thank you for inviting us. The banking sector particularly, those who are not yet our members, we do invite. And even individuals, if you're not yet our member, we shall give you our website where you can reach us and become our members. Otherwise, I thank you very much. Mustafa, do I declare this thing open now officially? Thank you.
Thank you very much, Dison, for those opening remarks and for those kind words. And thank you very much for promoting corporate governance. In line with our agenda for today, we are going to briefly show you the board remuneration survey. And when we ran this survey, it ran for more than 2 months. The feedback from the expectations, one of the last questions in the survey asked what are participants' expectation of this report of our analysis of the banking sector. And banking sector trends came top with more voice, more than 35% of the participants. And the impact of COVID on banking industry and the economy came second. And then the banking sector performance came third. And the trends in corporate governance, which further shows the need for corporate governance, came first. And then we had fraud management and then minimum capital requirements. So we want to assure you that by the end of the next 2 hours, you're going to get all of these in an equal dose. The survey population, we had 152 people filling the questionnaire. Out of that, 91 were board members, and then 45 were non-board members. That is the members who are managers, senior managers in banking. And then the other 16 were others. And that gives us a very good confidence that we had a very good response rate. People are interested in how board members are enumerated. So out of those board members, we had 42% who are non-executive directors of financial institutions. And then 27% were non-executive directors of non-financial institutions. And then 20% were executive directors of financial institutions. And the financial institutions EDs were 7.5%. So this also gives a very good confidence that the figures we have make a lot of sense for the industry. Out of the EDs, the 7 of financial institutions, around 34% earn less than $274 per month for their board roles, whereas 33% earn more. That's about 5 million monthly in total remunerations, all payments grossed up. And then also 33%, that's around the 2 members, and more than 5 million, but less than 10 million. So this means that there is a huge number of EDs in banks who are earning below the industry average. Then also we asked non-executive directors who earn the money between 3 to 5 million. So we got to know that 41% of 39 non-executive directors of financial institutions earn more than 3 million, but less than 5 million. So this means that on the average, financial institutions are paying this. There is only a small part, which is 29%, who are earning between 5 to 10 million. But we see that there are few directors who are earning less than 1 million. So this is something which is showing that if you sit on a given financial institution board and you're a non-executive director, on average, you should be earning between 3 to 5 million. That is $1,770. Then also we had the non-executive directors of financial institutions. Many of them, they are that is earn less than 1 million. So when it comes to comparing financial institutions with non-financial institutions, majority of the non-executive directors of non-financial institutions are actually earning less than 1 million on monthly average. So this means that financial institutions are paying very well. Of course, that goes to the competitive nature of the industry, and it also shows the risk, which the responsibility they have to carry. And finally, we also looked at the earnings of non-executive directors, and we had 64% of them. They're earning more than 3 to 5 million, and that was 22.2%. So with these statistics, we hope that it can inform boards to better enumerate their directors, considering the risk they carry. So when you look at the average, you would recommend that the industry, wherever, regardless of where somebody is serving, at least everybody should be earning more than 3 million and than 5 million. When it comes to financial industry, it is not about the size of the bank per se. It is about the responsibility and the risk someone carries. So with those few remarks, I'm going to invite my colleague. In case you have any question on this survey, we can take them and then we can go to the deep report. With me, I have Francis Mukembo, my colleague. Francis, you can greet the people.
Thank you very much, Mustafa. I welcome all of you to the Banking Report 2021. I hope you're all ready for the performance marks that are coming here. And do not worry about the position of your financial institution, as this report is meant to improve operations and look at operational efficiency. The banking industry generally has performed fairly well for a pandemic period, but of course there are a few hiccups in the industry and a few areas that we have to touch up. So this deep dive involves a lot of analysis, and we have based it off an international scheme and a rating system called the CAMELS. And this is the 4th annual. We welcome you to the 4th annual. I see as many participants as we had seen previously, and I welcome you, the new ones and the old ones. Yeah, so I'll hand over to Mustafa and we shall continue from here.
Thank you very much, Francis. As you can see, by the end of this engagement, you're going to know why are some banks making, growing and making a lot of profits while others are stagnating. And also you're going to know who is Uganda's most efficient and convenient bank. We have seen the pandemic has made many banks up their game. So we shall see these trends in terms of data and numbers. We're also going to see what are the dominant trends in the Uganda's banking industry, and of course, the winning business models. So let us now just go deep into it. Many times, people have asked us, why do we do this report and why do we publish it? We think that published financial statements by the banks themselves lack context and perspective. So it is very difficult to understand them, especially by the layperson. And also, even for the person who is aware, collecting this data, we have created a database of the banking industry from way back 1970s, microeconomic data way back 1960s. So we have a huge database of this information. So even if somebody is financially good, without a very good perspective and analytical trends analysis, it is very difficult to get the picture of the industry and how it has been developing. So that's why we publish this report. It is intended to give a mild deep analysis, and we hope this will promote transparency in the industry, but also make the leaders to know that somebody is looking at what they are doing. And we think this will create the need for change in terms of improve innovation and the digital transformation. So I want you to look carefully at that slide before you. We see that restructuring stabilized asset quality in 2020, but then we expect a huge ripple effect in 2021, because when the Bank of Uganda helped banks restructure the loans, it means that they didn't appear now on their financial statements. So some of those who restructured, some banks did not restructure at all, so they took the whole impact head on, but others restructured, meaning that they pushed the impact of the pandemic in 2021. So if you carefully observe that the yellow line, I know many of you are comfortable with the yellow in Uganda. So that yellow relates to trade balance. It has nothing to do with the politics. It relates to trade balance. So if you look at the way it has been moving, this is the December 2008 to March 2021. You notice that in December 2020, there was a huge dip. Our trade balance was affected by over 800 million losses or shortfall. So this goes to show you the impact of the pandemic it had on our economy. You know, Uganda's economy is highly dependent on foreign trade. And one of the biggest contributor to the GDP is export trade and mainly agriculture and industry. Now, when the border was closed, we had a lot of impact on of course, on our trade balance. But also, if you notice carefully, there is when the Uganda-Rwanda border was closed around March in 2019, we also experienced a big ripple effect, a shortfall in our trade balance, and that has been also came again during the COVID pandemic. So we see that much as this effect has not been fully incorporated in the financial reports of 2020, we expect it to be very clear in 2021. I will ask my colleague Francis to add something there.
Okay, thank you very much, Mustafa. One thing you should notice on the red bars, if you look at the red bars, those represent asset quality. Now, in 2020, around June 2020, you realize asset quality had started worsening. So the financial sector, that is our central bank, Bank of Uganda, directed financial institutions to restructure. Now, restructuring has what we call a long-term problematic effect. It expects our financial institution business partners, that is us, the consumers, to have recovered within a year. Now, sectors like the education sector and the number of those service sectors we've had are yet to recover. So in essence, what you're seeing there is going to ripple in 2021 at the end of this year. Already financial institutions are reporting, are no longer restructuring and are going to report worse effects. Some financial institutions took the hit this last year, and those that did not take the hit are likely to have a hit this year, this coming year. So prepare yourselves for something a bit astronomical at the end of 2021.
Yes, so obviously this means that from a strategic point of view, the banks must be doing some things, deepen relationships with the current customers, increase relationship management, but also try to understand their businesses more, not only using personal physical relationships, but data-driven modeling, whereby you look at the history of your asset performance and look at the sectors which are hit, as we are going to show you, and then you are able to do the right decisions. Again, when you look at the COVID-19 impact, it also affected the asset quality significantly. We analyzed the factors that affect asset quality in Uganda for the period of the last 20 years. And what comes out clearly, as you can see highlighted, is COVID. So of all the factors, the 364 treasury bill rate, the 91-day treasury bill rate, the agency banking, the financial crisis, inflation, lending rate, and of course, trade balance, of all of those factors, even including the financial crisis, COVID is the most dominant factor of all for the industry. So what does that mean? This means that usually in Uganda, whenever there is an election, also it usually affects asset quality. But now we have seen the economy has gone through an election, which is a tough one, but also it has gone through the COVID pandemic, which is a tough one. And we have seen it has the most big factor on it in terms of many of the businesses, because the economy was closed down, many of the clients who are taking money were not in business. So if you are not in business, it means that you cannot be able to pay and meet your obligations. But also you can see that whereas the pandemic was affecting asset quality, so many banks, what they tried to do was to go into treasury bills. That's why you see the 364-day treasury bill, but also they put a lot of money in 91. So now for corporate customers, they find it more easier to earn from a 91 treasury bill rate now, which also affects the asset quality, because that means that they are delaying the payment to their financial obligations as they first trade with that money. And because agency banking involves financial deepening, going to the villages, but remember, as you more develop agency banking, it means that some of the clients you are bringing on board may not be meeting the minimum requirements of your credit score and the evaluation criteria. So that's why also agency banking, you see, it had a huge impact on asset quality. Francis?
With the evidence that so many corporate clients are defaulting because of these short-term markets, the 91-day treasury bills, most banks have started, most corporate focused banks are starting to delve into the retail segments as they find them less problematic, and there is a lot of information they are now gathering in those areas. So the 91-day treasury bill in the past 20 years has continued to affect short-term payments of securities. of the loans that they are getting. They prefer a spread that comes in. So a treasury bill can be at 9% in the next 3 months, and the loan they have to pay in the next 3 months cumulates to just around 6%. So after 90 days, that is already a bad debt on the balance sheets. In other words, we are having a challenge in recovering that kind of debt. Yeah, thank you.
Yes, yes, Francis. But also, just to point out, when you see the worsening trade balance, meaning that people are importing more than they're exporting. So when people are importing more than exporting, it means that the cost of living increases. So when the cost of living increases, it affects their ability to meet their other obligations which they have. So this is why you see these factors have continuously, because of the COVID as the most dominant factor, affected the asset quality. And it is good that the economy is beginning to open, and the faster, this shows also the need for a stimulus package by government, because without a stimulus package, the pace of pickup will be very slow. And the slower that pace, the more it is difficult for the economy to really move faster. Okay, so speaking about the impact of COVID, we also analyze the impact of COVID on specific sectors. Because this economy is more dominant on agriculture, we looked at how COVID affected the key agriculture subsectors. When you look at the primary main agriculture processing, you look at agriculture support services, you look at forestry, these were badly hit by the COVID, because remember, most of these ones are export driven. You are looking at forestry, most of the products are mainly exported, but if you close movements, because this is not a one-on-one service, it means that people just keep the stock and it piles. And the more you pile capital, the more it becomes very complicated to move. I don't know. Somebody's typing something.
I know. Why did you?
Okay, so I would request that if you have a question, you can raise your hand or use the chat within the Zoom call in the chat. Thank you. So if you see agriculture, cash crops and the food crops, unfortunately or fortunately, these were not affected. You remember when people were locked down, the industry which kept increasing and growing, markets were left open, meaning that people had to eat. So this also gave a good relief to the business, because anybody involved in cash crops and food crops experienced a lot of demand. And that's why you see that banks which have internal business models and use the automation or business intelligence and analytics, and are able to know the performance of their clientele by lending at respective value chains, were able to succeed. Because, for example, a bank which lent to the food crops value chain or cash crop value chain was doing well. So, Francis.
On top of that, what they're doing is, what these banks are doing is focusing on the food crops and the cash crops. So focusing on these value chains is strengthening certain financial institutions. You're going to see in the performance of certain banks that focus on these specific value chains, that is the cash crop industry and the food crops, were able to even increase on their return on equity year on year. They increased the number of deposits and also increased the number of participants in this sector. So to make matters worse, some banks generated sophisticated models that manage to earmark those areas. Now, if you look at agriculture support services, agriculture support services is struggling mainly because of the fact that it requires physical contact. You see, the more you have physical contact, the more problems you get in this area. So when you look at it, agriculture support services, it requires a diversion from this physical contact. And the more it was happening, the more problems that were happening in this industry. So, okay. Thank you very much for that. Let's move to the next.
Okay, so also, I don't know, there is a background message on the slides. I don't know. We are going to remove the person putting that background message. Emily Mackinnon. Okay, so I'm going to ask my tech guys to see that I love the presentation. I don't know what is the message. Okay, so also we looked at the impact on services. And in Uganda, the services sector was basically the most affected. You can see those red bubbles. These red bubbles are highly showing the sensitivity of this sector to the pandemic. You can see hospitality, because many hotels were closed for a long period of time and the pickup has been very slow. You can see the financial and insurance industry was very highly affected. You can see the information and communication technology area, almost for some reason, you would have expected that this is doing very well, but somehow it was very affected. Industry highly affected. So almost the country's GDP year on year lost more than $1 trillion because of these combined impacts. Okay, fantastic. So I would request you tell the person to chat in the chat of the Zoom. Thank you. And then next time we should use some other method. Okay, so also we looked at the impact of the pandemic on fixed incomes. So we see that when you focus on fixed incomes, it shrinks earnings, and the impact is huge. I want to draw your attention on. I share my screen. Okay. Pardon me, I'm going to share my screen. I think there has been some technology.
Exactly, Mr. Mustafa, just put it down and share it again. Thanks.
Thank you. What is that?
Somebody is excited about Uganda, which is okay.
I'm telling you. I don't know who is that person. We can give them the opportunity to say something. Okay. So we looked at the impact of the pandemic on earnings, but most importantly, we realized that because of the pandemic, banks had to diversify, and that diversification meant that they put a lot of resources or assets into fixed incomes. So now, when you put a lot of assets in fixed incomes, it means that you are suffocating the private sector growth because they no longer have this money. But also remember, fixed incomes, because of the risk profile they carry, which is very low, it means that they don't get a lot of value for increasing return on equity.
And then when we were rolling out, we only went to few branches.
That was the issue. Yes, Francis.
Thank you very much, Mustafa. The aspect of fixed income has affected most corporate borrowers. So most corporate borrowers are struggling with most corporate lenders are struggling with corporate borrowers. The fact that they have so much information, they ask for a higher spread. And this has had a big bite on our earnings, on the earnings of the financial sector. This area here, fixed deposits have averaged time deposits have averaged 9% to around 12%. over the past 20 years, with certain peaks around 2010, there were higher peaks. Another aspect we need to focus on in this area of earnings is the fact that there has been a huge focus on fixed income securities. You see, with the pandemic, whenever a pandemic comes, the banks become a bit more prudent on lending, and they have to invest in these markets. So investing in these financial markets, that is the treasury bills and what gives you a spread of around 10 to 12%, or up to 15% on a favorable time, but that is still a lesser spread than the private sector credits that even attracts up to 30% for microfinance institutions. That's why earnings have been affected by these key areas as we move forward.
But also, you see that when the increased cost of deposits also affects earnings, because you find banks, they have to manage the impact of the pandemic and also balancing a lot of factors which are affecting them. On one side, there is potential assets at a high risk. On the other side, they have to preserve the minimum cash requirements. So they have to push to collect mobilized deposits from the public. And in times like that, people with the deposits, of course, are few because trading economic activity is low. So this means that they have to be able to get these deposits at a premium. And as they do so, the cost of interest, the cost of that deposit increases, which basically affects on the net interest earned. And obviously that affects the entire economy. I will ask my colleague Francis to continue with the how banks are very, very much susceptible to the banking industry risks. When you look at, you carefully observe this chart, it is looking at the market beta, how banks' earnings are exposed to the changes in the industry. So as you have seen, COVID affected the banking industry, and you see banks like Stanbic Bank, you see banks like Citibank, you see banks like, those were banks which are next to the x-axis on the zero. It means that now, for example, Stanbic, when we analyze their data for the last 5 years, it has a 0.81 beta. So with a 0.81 beta, it means that it moves with the industry. A slight change positively in the industry, it will make their earnings and income to increase. Likewise, a slight fall of the industry will also make their income to fall. Now, if you look at that business, of course, there are so many things, because Stanbic Bank is a big in government lending and corporate. So they were mainly affected by the pandemic. And that's why you see their business will be swinging as the economy moves. But then when you compare that with a bank like UBA, with a bank like GT, you find that it is completely different. I will ask Francis to move on.
Yeah, one of the most affected financial institutions in 2021, in fact, the most affected financial institution was ABSA. If you look at the bubble, the size of the bubble shows the impact of the pandemic, or the impact of the systemic shock. This systemic shock is for the past 5 years. If you look at the 5 years that have passed, Stanbic and ABSA have replicated the system's performance, and were only off when DFCU wrote off around 82 billion when after taking over Green Bank in 2017. 2018, there was a sort of ripple of bad debts where over 82 billion was taken out of perspective. Now, that's the only time you look at that curve. Now, if you look at banks like Postbank is the most defensive financial institution. It's not reported by the system. If you look at that, it is not reported by the system. However, Stanbic and ABSA move directly with the highly correlated with the movements of the whole industry. So if you hear a huge shock happening in the industry, you know these financial institutions are struggling big time. Now for ABSA doubles the replication. You look at ABSA down there. They have struggled in 2020, and that is one of the reasons as to why you see the growth in their return on equity has dropped significantly, more than double the industry's drop. That is around 2000. If you look at that, that's more than 2.5 times the industry, if you in that instance. So these financial institutions need to to generate business models that are going to be able to protect them from these systemic shocks. Postbank is being protected, generally speaking, because of its diversity and the fact that it is also being financed. It has clear financials that are government-centric, and also another option you look at is the type of sectors it has been focusing on are the most stable. Uganda's backbone is agriculture, but banks are still struggling to finance agriculture. They are worried about it. But these banks like Post, as you can see, are leveraging from it. Now, corporate bankers, if you look at Absa and Stanbic, they have a lot of corporate banking involved. So that shows how much a shift can happen to those specific areas. Now, to those specific banks. Now, banks that you see at the far end of this chart are banks that have more problems than just systemic problems. So if you look at a bank that is far away from the center, they have other volatility problems that might include internal issues. Sometimes it could be fraud. So all the banks on the right are aggressive. They move systematically with the system. So they are exposed to systemic shocks. Now, the ones on the left are what we call defensive. They are not moved by the system. So even if the system moves, they have adopted models that we're going to discuss about as we move forward that have managed to push them back from that area.
Yes, from a strategic point of view, so banks must begin asking themselves, how do we create business models that are not affected by a huge extent by the changes within the market itself, so that you are able to be insulated from sudden changes in the industry. For example, all of you know that the story of UBA, when it came in the market, it remained operating, but of course in the retail and of course corporate lending, it struggled for a period since it launched from 2008, way back up to 2015. So around that time, they basically changed their business model. And that meant that, of course, at a risk of emission drift, as we're going to show you, that meant that they put more in the secondary market. They put a lot of investments in the secondary market. So this is why, because they put money in treasury bills and that kind of trading, that's why you see that they are less susceptible to the changes in the industry. And this means that also, as banks are thinking, the question is, how do we change our business model, introduce non-interest income, but most specifically non-funded income that is more resilient from changes in the market caused by maybe economic difficulties. We have spoken to you about this, showing you how the banks which are more susceptible. You notice in 2018, just in 2017, DFCU balance sheet was affected by the acquisition of Prime Bank, and in the following year, it wrote off around 82 billion. So that affected the industry average of the asset quality. But when you look at the performance, generally, Absa has an estimated market beta of around 2. So meaning that a slight change of the economy in any direction affects the Absa twice, which is not very good, because it means that the business is so much intertwined with the way the economy is operating. That it speaks to the kind of sectors it is lending to, and of course to the business model it is pursuing. So it is very important. Some of these strategies may work, but it is very important that you carefully think about long-term value preservation and what are going to be these models. And we have seen from the acquisition, Absa, since it replaced Barclays Bank, has been driving a digital agenda, and we think these developments, as they diversify into SME and the retail big time, can help to reduce this systematic risk. But most importantly, we'll also looked at the market penetration. What channels are going to be game changers for the banks? When you look way back in from 1980s, bank branches, when penetration per southern adult population was the thing. So winning meant that you must have a countrywide branch presence so that you can reach as many people. But we have seen that with the launch of mobile telephone in the country, and mobile penetration increasing, but most importantly, the USSD banking options increasing, and then of course the mobile banking option with mobile apps increasing. We see that mobile became the biggest driver of penetration. So any bank which did not embrace the mobile banking and in that USSD banking, it means that it was having a negative jaws. In finance, we measure the rate at which your costs, your revenue is increasing relative to the costs. So if your revenue is increasing slower than the rate at which your costs are increasing, it means that within the next maybe 3 years, you are going to find that you are being strangled yourself because the costs will be surpassing your revenues. And that's what was the impact of the branch. So this means that banks which have got a branch presence must now begin thinking about using them as experience centers, whereby you don't set them up for people to just come and transact, but you're setting them up for people to come and get more value, manage their wellness, get financial advice, connect, so that they find that there is more value over and above the branch, because penetration will no longer be the point where you have a branch. Service and the alternative income sources at the branch point should be the driver from a strategic point of view. But also when you go, you see that agency banking has become the biggest driver. But now as you move with agency banking, you know this is doing financial inclusion pure. So there must also be a unique strategy for you to win with agency, because it has basically got banks to the, as the government likes to say, to the household, but now in this case, to the garden and things like that. So you'll find that the agency banking, because the people are known to the community, it has driven some banks. We see very many good banks making a lot in terms of penetration in that area. So from a channel point of view, we see that, of course, when you look at the voice, the share of ease of access and convenience, you are talking about agency, you're talking about mobile, USSD for the majority, and of course, mobile app, and then transforming branches into experience centers so that you can leverage from relationships and those kind of opportunities. In part 2, we give you a deep dive, if time allows, into the capital adequacy. Basically, you are looking at the ability to absorb expected losses, which is looking at, are you solvent or you're not solvent? I will ask my colleague Francis to come in.
Yeah, capital adequacy, we are now looking at how much capital our financial institutions have that can be able to absorb any loss. What if tomorrow you have a bank run on your bank? Everyone withdraws their money. Are you able to sustain that? So on average, we are having, according to the Basel III guidelines, you should have at least 10.5%. So before we go deeper into the capital adequacy, let's look at the proposed amendment of the capital structure, where tier one financial institutions are commercial banks. Commercial banks are going to be required to have capital reserves of at least 150 billion. Tier 2, which is credit institutions, will have at least 25 billion capital reserves to overcome systemic shocks. This has been due to what has happened in 2020. That's why I say it has not been replicated because of restructuring, but it's going to have a ripple effect. Now, these are mechanisms to ensure ripple effects do not occur going forward. Now, tier 3 is going to, that is the microfinance deposit taking institutions, is going to be required to have at least 5 billion. Now, if you look at on your left, the financial institutions that are going to remain as commercial banks are just about 10 or so. And a number of them are going to be, if they will have to restructure their capital reserves in order to maintain their positions as commercial banks. Most of these banks, as you can see down here from around Pride, the ones in orange, are going to struggle a bit in order to maintain their positions as credit institutions. Some of these microfinance deposit taking institutions like Pride have as much capital reserves, more than most of the financial institutions that you're seeing on your left. So all of these financial institutions are going to be affected by these amendments. That means there's a need of a restructure in the business model, and there is also a need of reducing the risk-weighted assets that you're having. Risk-weighted assets are risky assets on the balance sheet. So mechanisms like intelligent credit scoring models are being adopted, but only less than 5 financial institutions have intelligent credit scoring models. You can imagine with this occurrence.
Yes, thank you, Francis. But also, if you carefully see, we have not included the supplementary capital in the core capital because it is almost negligible when it comes to this kind of the requirement by the regulator. So from a strategic point of view, we think that maybe because many banks are affected, we see that if Bank of Uganda is going to put their feet down and require compliance to this new requirement, we look at a transition period of 3 to 5 years because the impact is going to be sudden, especially for the industry. As the banks are given a breathing space to mobilize more capital, and maybe it would be also a very good welcome move if they can also decide to go to the stock exchange to look for this kind of funds to meet the minimum requirement. Because now for the banks below Pride, we see that is now the top agenda at any board meeting, top agenda at any EXCO meeting, because this is a regulatory and compliance issue. Yes, Francis.
If now looking at the capital structure and the capitalization of 2020, about 3 banks were undercapitalized. That is Orient Bank, Mercantile Bank, and BRAC Uganda Bank. Most of these financial institutions are highly exposed. They are lending and they have limited stock of secure securities. If you look at their balance sheets, they have not protected themselves in case of a shock. So they will need to readjust some of their business models. Of course, we cannot say COVID is a short term. As we saw the financial recession 10 years ago, we could have another ripple effect in about 5 or even 6 years with a similar incident. And without a restructure of business models, including a protection for our consumers by having at least a much more interest in fixed income securities, these financial institutions are going to really be bothered. But some banks some financial institutions that have high capital adequacy ratios are being a bit so prudent in lending. They have very little risk-weighted assets. They're being too prudent in that they are missing out the aspect of financial inclusion. So you don't have to be too prudent again in order to keep capital reserves. You just have to maintain models that are really relevant. We've seen financial institutions that are really doing great, lending out to as many people as possible, but still maintaining high capital ratios. Yeah, there's a tendency to become extremely prudent in order to avoid a problem with capitalization, but this has to also be checked in essence.
Yes, thank you, Francis. You'll notice that top finance bank is not showing in this undercapitalization chart because it is already in negative capital, and that's why this chart only shows banks which have got a positive figure. But also, you notice that a bank like ABC being 73.9%, it could mean that they are prudent in lending, but also it could mean that they are not sweating their assets and going out as much as they should, because that basically means that they are just having a lot of money with them. Thank you. Okay, so here we look at one of the biggest risks, which is now going to affect the banking industry. When you look down, you find that they are from DTB, Stanchart, GT, they are spending too much. They are earning too much money from other than lending. So if you look at the Frank-Dodd-Frank Act in the US, it is specifically, I don't know if we can specifically, I don't know why on my slide something is not showing. I wanted to show you. It specifically requires that commercial banks should not be trading their deposits of customers in speculative investments. Like obviously, when you go to invest to operate as an investment bank, you are denying the private sector the capital which they need. Now, banks like smaller banks like Ugaford are not only using the entire capital, but and also using the deposits, but also borrowing to go and just put money into the market. They are specifically putting everything they have into lending. You go to BRAC, the same thing. Then you go to, of course, this means that you are like driving at night, maybe blindfolded, because it gives a huge risk exposure. So if you look at banks like Pride, the banks which are between 70 to 80%, you would say that is the ideal area where you expose at least your assets, 70% of your assets into that. The rest, you can expose them to other investments. So we look at these banks in the middle, between 70 to 80 or 85. We think that is a very good mix. But for the economy and also for the regulator, it becomes very difficult, especially for banks categorized as the commercial banks. When you go to Bank of Uganda website, you find that all the banks in Uganda are commercial banks. Now, of course, commercial banks is intermediary, get money from depositors, and then of course, you can lend to the ones who need it and grow the economy through private sector lending, which is affordable at convenient times. But now when you get to mobilize these deposits and then pump all of it into investment, it means that probably maybe the economy is not getting the benefits that they should. And we see some of the banks which are going into securities are actually very big banks, and that could have an effect. While we understand that in some of these international banks, when the financial crisis happened, they were the most affected and they were highly exposed. So it could be that maybe they were, as a policy from the head office, recommended to go slow on lending. And obviously, because it is not a good leadership to keep money with you, and the best alternative is to just put all the money in securities. But we think that this trend may not be maybe sustainable, and like the USA, the way it came up with the Frank-Dodd Act following the financial crisis, we think Bank of Uganda should also begin regulating on thresholds so that the economy, especially private sector players, are not mildly affected. Francis?
If you look at these banks in red, the ones below, it becomes unfair to their consumers that they take your deposits and only lend out less than 50% of these loans. So the rest of your deposits are used for their personal trading. So this is we're looking at the loan to deposit ratios. So banks that are doing this completely are utilizing the fact that our regulation here is weak. You see, the Volcker rule in the Dodd-Frank Act that Mustafa has talked about prohibits some of these behaviors to a certain extent. So if the central bank can also prohibit and at least enable these banks to lend out at least 50% of your deposits, that's why we find interest rates are getting higher over time, because there is limited lending. The money is going into these securities. So securitized products, you find themselves investing in these securitized products and affecting most of our banks and other smaller financial institutions. So, however, of course, lending is also advised. But if you go beyond the threshold of around 90%, you're now becoming, of course, overexposed, because you're going to borrow to lend. When you borrow to lend, it means you're paying higher interest compared to a person who's collecting from deposits. So if I borrow from another institution to lend, of course, I'm paying around 9 to 10% or up to 12% on interest. So I'll have to overcharge my consumers in order to recover a simple spread on that. So that is why you're seeing the two red zones, that is the upper limit and the lower limit. So these are, so the preferred ratio should be around 70 to 80% of your deposits being given out to the consumers.
Yes, fantastic. So, of course, we also looked at the projected rate of return on the industry, and which bank has got a resilient business model to win most. So this is based on a 5-year forecast. If the current trends are kept, which bank is going to be most valuable? So we see the banks which are embracing digital, they are using alternative channels, but no longer now using alternative channels in silos. They are using them as interconnected channels to create a very outstanding customer experience and also deliver convenience banking, are having more favorable valuation point. So if we had mapped, for example, MTN on this chart, you would be able to see maybe where does it stand. But most importantly, also, you need to be looking at the cost of capital, because when you get the overall weighted cost of capital for these banks vis-a-vis their returns, which is expected, it would give you an indication that now is the time that the business model has to change, because if you continue doing things the way you're doing them, it would be maybe not sustainable. And now that's why you see banks that have a low, more operational efficiencies with a low cost cost to income ratio are moving in good areas. For example, banks like Mercantile, banks like Stanbic, thanks to automation and digitization project which have come strongly. Banks like Centenary Bank, banks like EcoBank, which have got a lean operations, are having a more projected rate of return. And we then also looked at Uganda's biggest financial institution brand. We looked at the model of the Interbrand and the Francis, just as my colleague has done.
Yes, Interbrand values company brands based on their fair value, their enterprise value, what we expect as business value in the future. So the figures you're seeing here are in millions. So if you see Stanbic, that is 4.1 trillion business value given back to its consumers, given back to its shareholders. So the biggest brands are much more expensive. The biggest brands are much more expensive, and they are much more expensive to trade. If you put them on the financial markets, they will give you much more return, and they will be traded at a higher price than the peers. So as you look at this, these are expected cash flows for the shareholders. So the biggest brand, of course, is Stanbic, followed by Centenary, Equity Bank, Absa, EcoBank. But remember, these are the biggest brands on a 5-year horizon. Going forward, of course, in 5 years, with optimization of your business models, you can be able to recover recover from this and even push up your brand going forward. There are banks with even less asset base than others. If you look at the likes of EcoBank, EcoBank has moved forward with its kind of business model. It ensures it always keeps a lot of cash for investment, and this cash in the long term is going to be a leverage to push out much more investment. So you can work hard towards this. If you look at the number of banks like EcoBank, Postbank, their asset bases are not as huge, but they still are competing with the top tier banks. As you can see them, even microfinance institutions that are microfinance focused institutions. Let's say the likes of Opportunity and BRAC are also pushing their brands bigger than even commercial banks. So in essence, what you can do is ensure your business model adapts to the environment. Banks like Opportunity Bank are up there because of their business models, not just because of the cash. Even the business models are able to help them leverage in essence and help them obtain such kinds of necessities. Okay, thank you, Mr.
Thank you very much, Francis. So this means that the foundation for strong brand valuation is rested on the current business model, but how are you managing your current costs in a way that is sustainable, so that it is not going to eat a lot into your reserves. But also, we analyzed the risk management by looking at the factors year on year which affect risk management, especially at the financial institution level. Looking at the capital adequacy ratio, looking at the fair value, like what we have been showing you, looking at, of course, loan to deposit in terms of mission drift, and getting the industry average of this. So we find that on the balance of probabilities based on our analysis, remember all the information which we are sharing with you is based on published financial reports by the financial institutions, which they are required to do every year by the law. So we see Housing Finance Bank getting the average lowest score, meaning that it is managing very well. They have a very favorable loan to deposit ratio. They are having a very fair valuation because of the stable kind of sectors they lend to. And of course, their capital adequacy ratio is adequate and sufficient. And of course, at the bottom, we see, of course, the banks which we see with a microfinance business model, somehow, especially like Ugafort, and surprisingly Orient Bank, because if you look at Orient Bank, it has a very good asset base, but when it comes on many factors, it is doing badly. And then also, as you can see, Finance Trust Bank. Then also, Yes.
So in essence, if you look at this, if you look at those factors not only cover current positioning, even year-on-year growth has been covered. So if you look at the best performing risk management function there, most of even the year-on-year trend, the improvement over the years has been considered significantly. So, so you have to be able to not only work on what you have previously generated, but you should be able to you should be able to have this information and be able to improve on the risk management function of your organization over the years. You need what we call a trend analysis. You need to improve year on year.
Okay, so now we're going to the part 3 of this analysis based on the CAMEL, which is the asset quality. And the on asset quality, as we showed you, Bank of Uganda saw the impact of the pandemic, and what it did was to recommend restructuring. So some banks like BRAC accepted to take this impact head on because of the nature of the customers. And you can see maybe in this financial year 2021, the ripple impact which will happen to some banks which did not restructure will be more worse, because a bank like BRAC may show it is adverse, yet actually they decided that they will not restructure their customers. They will just report that, and obviously you would say that is also very prudent and in line with the expectations of the IFRS 9. Now, the red line which you see is the expected provisioning for impairment loans aligned to IFRS 9 requirements, which are more prudential than the former IS at 9. And that was the projected impact. However, when you get that provision, at the date of reporting, this white line shows how much that impairment loss wiped out the income. So for the banks like KCB, you see it is instead positive. It means that the provisioning which had been made was more than what actually happened. So they got a favorable positive impact. So going forward, especially for the individual bank themselves, asset quality is a very critical driver to manage.
So on the basis of this graph, I see some. If you look at the red line represents the impairment to net loans, and the white line represents how much that impairment wiped out your operating income. So if you look at how much that impairment wiped out your operating income, equity wiped out over equity's impairment wiped out over 54% of its operating income. So it doesn't mean that equity may have the highest exposure. These are provisions. Of course, the more you lend to high risk segments, the more provisions, the more you provide. IFRS 9 means expected losses. So as soon as I get in my loan in this financial institution, they automatically look at my historical factors and know how much money they will put aside. So that money they will put aside is what the red line shows. The red line shows that, and that is as a percentage of the total amount of loans. So that upper red line that you're seeing there is what I'm not provisioning. But what you see down here is on the income statements. On the income statements, that is what the operating income has been wiped out. That is how much operating income has been wiped out by these specific provisions. So if you look at this, Equity, BRAC, and NCBA had a very huge credit wipeout, credit exposure wipeout. But this money can still be recovered. It's expected losses. So if they're not recovered, that's when they will be confirmed, and that's where we shall find out what happened in the next slide. Okay, now here we look at what we call the asset quality. Now the asset quality, we look at what we call the NPA to net loans, the non-performing assets to net loans. So how many of these loans were over the expected payment date? They were overdue by the time they reported on 30th December. Yes. So if you look at this, BRAC has 21%, followed closely by finance. I think the projection is not showing clear here. You cannot see the bank down here. So what BRAC? Then there is a Top Finance Bank, there is NCBA, and a number of financial institutions are doing relatively struggled a bit, but most of these took these impacts head on. So these the bank with the highest level has the highest asset quality. Now this the highest asset quality, as you can see. So in essence, those banks that had the lowest asset quality are the ones at the top. The ones that had so many problems with their loan books. Their collections were a bit problematic.
Okay, obviously we shall have an open time for questions, and also in case you think there is any issues of the data, we shall show you. Okay.
Okay. So now, as we move forward, we are still on the area of restructuring. So there was inadequate restructuring for some of these financial institutions, but of course, you see with the restructuring moves. Restructuring moves your problems going forward. So in essence, and if you look at this, these are figures reported in the financial statements. So having the highest, when Equity, BRAC, and NCB have the highest exposures, they have the highest exposures on their income. So if you have provisions of around 20 billion, how much of that 20 billion has wiped out your operating income? So if you have the most, if your 20 billion wipes out your exposures, if your 20 billion wipes out your operating income, then you expose too much. Your profitability is being exposed, and you're reducing, in essence, in performance. So your profitability has been damaged. But of course, we shall be able to see other aspects of these models where these banks have been able to recover from this stress that they are experiencing right now.
Yes. Now, from a strategic point of view, this means that one, at in individual bank level, there is need to focus more in robust credit modeling so that you improve overall asset quality. And we think that machine learning and artificial intelligence kind of analysis into the portfolio to study the performance of the previous credit is very important as we move forward, because much as you are restructuring, that means that you are restructuring with a reason, and those reasons are substantial, because you need to basically create. We are fixing something because we noticed the x-axis is not showing, so just bear with us. We are about to finish. We are going to open for the question and answer for the next 30 minutes, so no worries. So here we look at the banks which had the highest write-off, and of course you can see ECO wrote off 7.56, DTB wrote off around 5.36, and the NCBA bank wrote off around 4.97. So of course, writing off could also mean that the sectors which had been invested, which they had given were very high risk, but also it means that they did not restructure. So they chose to take the risk on. So we also looked at the factors that affect credit risk management. This include non-performing assets to net loans, non-performing assets to deposits, impairment, loss coverage, write-offs to loans, and then go to the average. So on the general average, we find that banks like Yako, Bank of Baroda, Uganda, and the Mercantile Bank, UBA, they are actually managing credit very good, but also this speaks to the nature of their businesses which you have. So you find some of these organizations are lending to specific groups where there is a lot of, I would say, people know each other, a lot of relationships, and they are able to manage this kind of risk. For UBA, you know, it's scaled down on lending, and that means that, as you know, you remember, it is among the worst in terms of mission drift, in terms of loan to deposit, because they are giving it a lot. That's why you see it has a score of 13.64. Okay.
So now, on top of that, if you look at the figures there, those figures not only look at the NPA to net loans of this kind of 2020, they also look at the movement year on year. So they are weighted averages of the two movement, weighted risk exposures of the two movement of the 2 years. So if you performed well on both movement and also you improved on your non-performing assets to net loans year on year, and you also had a good non-performing asset to net year compared to the industry, you score very well as a credit team. So the credit teams that are struggling scored poorly in that period of time. So they were affected by the pandemic, generally speaking.
Fantastic. Thank you very much, Francis. So also we looked at management efficiency, looking at how, you remember in the CAMELS framework, we were analyzing each of these factors one by one. And there is nothing which can indicate management efficiency other than what we call the sensitivity heat map, or the ability of the banks to play in the target zone. Obviously, every bank would like to have a low cost to income. When you reach a level of seamless banking, where the various multiple channels are not working in the silos, because we have seen the trend from at least from 2017, banks have been creating multiple channels to reach the customer. But now some banks are still running these channels as if they are in isolation, as if it is a deeper implement of its own, without looking at how they leverage and interconnect themselves. So obviously, when they are running in silos, it increases the overall cost of operations. So the banks which you see are like in the red zone, it means that they are carrying a very high cost to income. Remember, when we are doing the cost to income, because of trying to even out the impact of management efficiency, we don't include the provisions, because I've shown you the provision in their own. So you note that banks like Equity, they are basically trying to cut a lot of costs and they try to be efficient in the operations and nimble. Banks like Bank of Baroda, banks like Citibank have got limited operations, so they're also very. So you find the banks like EFC actually doing very well in terms of cost management, the same thing as Ugaford. That's why you can see that despite a bank like this, you even Centenary Bank, Stanchart, and of course Stanbic Bank and Bank of India, despite a high exposure of loan to deposit ratio, which is very excessive, the bank is really very, very efficient and trying to sweat their assets as much as possible. So at the end of the day, the higher the cost to income, the more the bank is likely not to be profitable and sustainable. And then also we look at what is the contribution of non-interest income. But in this non-interest income, you know, the reporting of Ugandan banks is generic. It is not to the detail. There are a few banks, as you will see, that provide at least detail. You'll find that when they are reporting, they will say administration costs. So in which case the administration costs is bundled up and you are not able to break down and see of that administration cost, which is a finance staff cost, for example. So you can't be able to see that. But then also we look at the income in terms of the total income. How much is your contribution on interest income? Because non-interest income is the biggest, best measure of efficiency. Now, in that, we try to open it up also and look at what is the non-funded income component, because that is now the income from innovations, because the non-interest income that is coming from, for example, charges on loans, charges on bank fees, monthly charges. We will not say that that income relates to management efficiency, because it's like you are charging for inefficiency and transferring the banking costs to the customer. However, if you give me a mobile application and I transact online and therefore you charge me for doing that, because I know if I walk to the bank, it costs me 50,000. If I do my own mobile banking, it costs me 30,000. So even if you charge me 30,000, I will see the instant benefit of that income. So we are trying as much as possible in this analysis. The non-interest income includes a lot of inefficiency charges. But now the future, from a strategic point of view, the future banks which are going to win in this area will be those banks which are going to be like scaling down the charges of inefficiency as they grow the charges of convenience. Francis.
Yes, and the element of mission drift is shown clearly by United Bank of Africa. That is UBA. UBA has more than 50% of its income coming from non-interest income. That is in capital gains of treasuries and all those kinds of transactions that you can be able to talk about. So it's clearly showing a mission drift. If the bank is an outlier out of this entire circle, you know it's mission drift that is happening. Equity for so many years has been offsetting its branch costs by reducing branches from more than 100 branches. They are now just a few, close to around 45 locations, and it has embraced what we call the agency banking model. The agency banking model.
Yes, so meaning that going forward, we see that the competition is going to be in how do we be nimble, and of course, focus on the costs. We see staff costs and administration costs are some of the biggest drivers, and the banks which are going to manage that will be good. But also we looked at the factors that affect convenience banking in Uganda, trying to look at which banks are the most convenient. The banks which you see in the middle with a big green bulb, for example, ABSA is the most convenient, Stanbic Bank most convenient. You see Equity, you see Stanchart, Centenary Bank, DFCU. Why we are looking at the factors which they are giving to the customers so that they can access their services. So we are looking at the mobile money application. How is it working and ease of use? We send out to researchers in the market. They try to access many of these banking services, and they are able to give you the feedback on how they use. So we use open source intelligence in analyzing some of this. Then, of course, the platform they have, how are they managing origination up to delivery of the service to the customer, and what is the experience when you're using those platforms in terms of more than one USSD, for example. Can they support both MTN? Can they also support other telecom service providers instead of constraining the customers to only a single vendor? And also we looked at a bit to get a micro loan. You know, there has been a new law, the National Payment Systems Act, which has been passed in Uganda, effectively giving telecoms to come and prey on the traditional market of the banking. And of course, you have seen what happened to the Nigerian banking industry when MTN got the same license in Nigeria and opened the mobile money financial service in the market. So we have seen this is what is happening. We see even Airtel launched a financial services company and innovations, the same thing which happened by MTN. So this means that the banks, if they are going to at least fend off or compete favorably with the telecoms, it means that they must be able to create these kind of capabilities and make it more seamless, because you note that the biggest area or the green field in banking globally is payments. So the fintechs, they take a lot of payments. So now if you remove banking from payments, it means that banking will be losing a lot of money, but most importantly, agency. So when you look at the ticks, they are showing where which of the banks has provided multiple channels, and not only providing them, but making these seamless. And you can see across board, many banks are still not yet providing maybe a unified delivery channel, but we think that this is moving in the right trends, and the one who more optimizes will win. Francis.
We looked at listed companies. The listed companies, you see, the financial industry is the most developed industry of Uganda, and it's supposed to be the market driver. So there are only around 6 listed companies, of which 3 of them are cross-listed on Nairobi Stock Exchange and also in Uganda, on the Uganda Securities Exchange. And of course, with listing comes reporting. So when you list, you can give us as much comprehensive information to the consumer as possible. You're as transparent as possible. And some companies, irrespective of listing, are doing well. The likes of Centenary, the likes of BRAC, the likes of Housing Finance Bank are reporting with detailed reporting, irrespective of the fact that they have not listed. They are making sure their consumers are confident in their operations. They do not want to get a shocker that happened like in 2017 when we got a shocker in the banking industry that might shock the consumer deposits. So reporting improves governance, generally speaking, and giving as much comprehensive reporting to your consumers ensures there is confidence in consumers banking with you. And we are encouraging more banks to continue listing. As the more you list, the more efficient your governance structures are.
Yes, thank you very much, Francis. And also, of course, people will say that we are always having notes in the published statements. Even when you go to the notes, there are some banks, for example, they will only publish the one-page published statements which appears in the newspapers. Is the only thing you will see. Even when you go to their banking halls, that's the only thing which you will see. The other annual report which is published, maybe it is just available internal and to selected stakeholders. You go to their websites, you don't find that kind of report there. But even then, the kind of other detailed information in terms of strategy, in terms of sustainability, in terms of board performance, in terms of those other ESG factors, in terms of linking sustainability reporting to risk management, you find these things are not there. So when we are writing and giving you this kind of analysis, we are basically analyzing you against the best in the industry in terms of what does it mean when you do transparent reporting and the breakdown of various costs at their minute levels so that people have visibility into your key cost drivers. You'll find that there are really very few banks and mainly the ones which are listed that go to that kind of detail to provide it. And we think that is very good. So that's why when we are looking at management teams, we are looking at which team was able to manage the cost of deposits. Because at the end of the day, it requires strategic thinking to be able to optimize deposits and keep them low. You don't want to have the cost of deposit almost rivaling the treasury bill rate, because that means that you are going to be carrying too much risk. And this was year on year. We looked at the cost to income. We looked at whether you are listed or not listed, because we know when you are listed, you are going through a lot of compliance requirements, and the rigor of reporting is very detailed. You can ask MTN in this current IPO, and you'll be able to know what preparation is required for that kind of listing. But that's not enough ongoing compliance. We also looked at non-interest income composition, and in that non-interest income, our main focus would be, does the bank, for example, provide the breakdown of the non-interest income from the income which is funded and the one which is non-funded? Because we know that if you are getting more income from, for example, wealth management, if you open many financial institutions of many banks, you are not going to be able to see how much of the income is coming from, for example, from forex trading. You may not be able to see it. How much is coming from those breakdown of the various income sources and the innovative products. Then, of course, the nature and the detailed nature of reporting and the ability of that bank to be convenient. So you can see the top financial institutions, because some of this convenience requires huge investment. We see Housing Finance, DFCU, DTB, Central Bank, Bank of Baroda, KCB, Stanbic Bank, and Equity usually coming on top. Yes. So also we looked at the earnings and profitability, and we are looking at which of the banks suffered the highest hit.
Looking at earnings and profitability, of course, the biggest return on equity from the industry is Stanbic Bank and then Centenary. These are banks that have efficiently used their shareholders or stakeholders' money to make more value, to bring more value. However, you should look at the upper bar. The upper bar looks at the growth of return on equity. So if your return on equity grows by less than 1%, less than 5%, it means there's a bit of stagnation in growth. You should be worried about the earnings. You should be having a return on equity of at least 10% and above to show the shareholders that yes, the business is continuously growing. But because of COVID, of course, we saw a stagnation in the number of financial institutions. Now, financial institutions like Stanbic that are highly exposed to systemic shocks have already shown that there was some stagnation in earnings. If you look at the return on equity, there is 24%, it's on top, but of course, it only grew by 1.4% year on year. So all the institutions that you're seeing here, these are around the top 15. Of course, there are some institutions that had less return on equity than the industrial average that have not been shown here.
Thank you. I think that is very clear. Please, you can continue. So you can see also we analyze the cost of deposits because in the banking, of course, you are looking at the quality of the loans you have given out, but also the cost of the assets which you have. In the industry, of course, also it depends on the strategic positioning of the given financial institutions. You know, Stanbic Bank history, so they are almost the primary bank for government, and they basically have a lot of stock of government funds, and that's why you see their overall industry cost of deposit is slightly lower. Then, of course, followed by Centenary Bank and the Citibank, and then when you come to the end, you find that banks like Top Finance Bank, banks which have to go over and above to mobilize deposits, they are doing it, they are getting very high. So what does it mean strategically? It means that banks which are having a huge cost of deposits must begin undertaking aggressive, deliberate deposit mobilization strategies from at least retail, because you know, if you go to corporate to mobilize deposits, corporate has information asymmetry. They know most of this information, then they're going to bargain you down. And that means that digital agenda and of course agency banking and these channels that make it easier to mobilize deposits would be the things which are recommended. Okay, okay, Francis.
Yes, and on this chart, we look at the areas of net interest margins, the highest net interest income. If you look at the right, microfinance institutions have the highest net interest income. Net interest income looks at the spread between interest income and the interest expenses we experience you have. So most of these microfinance institutions charge very high interest rates, and it's evident because of their unsecured borrowers. The high risk level of borrowers also attracts high interest rates. So if you look at retail lenders, those ones that are lending to retail markets, they have to charge you highly to borrow excessively. So for those in corporate markets, they will have to charge less interest, and that's why their interest margins are a bit lower than the industrial average. Some financial institutions that are focused on fixed income securities also have lower interest margins because they are going mission drift and they are preferring low interest risk-free or less risky investments and over the more complicated ones. Then on your left, you look at the growth of assets, deposits, and revenue. We do not look at assets in terms of figures, of absolute figures. You can have 20 billion of assets, but you're not efficient. You're not efficiently growing them. So owning the assets is one thing, but growing the assets and deposits and revenue is the other thing. So we looked at those aspects, and if you look at that, EFC, Yako, and Opportunity Bank and Equity are growing the deposits efficiently. So in other words, banks that you're seeing below, like the Top Finance, Orient, and KCB, are struggling with growing either assets, deposits, and revenue, irrespective of their huge asset bases. So they need to efficiently optimize these assets in order to continue growing their financial institutions.
Fantastic, fantastic. So we wanted to maybe end this presentation so that we can take on your questions. Also, we looked at finance management looking at the critical areas which would say would sit within finance, and that looks at sweating the assets, how effectively are the assets being managed, looks at deposit mobilization, how are you growing your overall deposits, looking at net interest income margin. Remember, this is the year on year, looking on return on assets, return on equity, and of course revenue, and getting the industry average and the benchmarking. So on this score, you find that EFC, Yako, Equity, FTB, Stanbic Bank, Mercantile, Post Bank, and Centenary Bank are coming on top. We have put best finance management because we know that it takes a lot of leadership presence to be able to balance all these over 6-7 factors to be able to keep the bank very solid and resilient. And finally, we looked at overcoming short-term liquidity shocks, the stock of liquid assets versus cash coverage. I will ask my colleague.
So highly liquid assets, we are talking about securities and fixed deposits. These are low interest securities, but however, the good thing, you can sell them on the secondary market in cases of liquidity shortages. So you can easily sell them off at a discount and recover some sort of leverage to cover up for any liquidity shocks or shortfalls that you might have. That is the highly liquid assets. So we do not include loans and long-term investments or financial investments. So if you look at this, you can easily tell the banks that are already mission drifting. So if you look at the percentage of highly liquid assets to earning assets, UBA, Citibank, EcoBank, and Stanchart have in fact, even Bank of Baroda, they have over 50%, over 60% of their assets are in highly liquid assets. That meaning there is little amount given to the borrowers in the private sector. So they're not bolstering financial inclusion, although they are being secure. Their treasury teams are being as much secure. So sometimes prudence may affect the private sector, but it's also needed to a certain extent, not to a higher extent. However, there are also financial institutions like Top Finance that you see behind there, the EFCs, the likes of Yako, are struggling with highly liquid assets. Most of their amounts are into loans. So in case of a shock, they may struggle as much to protect their cash reserves and deposits. On your right, you can see the cash coverage. The cash coverage looks at how much cash you have as a percentage of your assets that you have. So you want to know how much cash can you give out in case your consumers wanted to deposit their money at once, would you still be able to operate in the next 12 months? Yeah, this is something we look at in that instance of cash coverage.
Thank you, Francis. So also we looked at the treasury management, looking at cash coverage and liquid assets, as we have already told you. And then finally, sensitivity to market risks. We looked at the most defensive banks and the most aggressive banks. And also this speaks to the business model to make sure that you consider the model, diversify so that you are able to remain resilient. And in summary, we looked at the individual bank analysis, and we find that Equity, UBS, and another bank are among the top, what you would say, safest banks in the market. So I will ask him, Francis, you want to say something? Yes.
Okay. This is now the bank performance. So if you look at the bank performance there, this is how your bank performed in the general industry. So this is in essence, if you're from the green side on the right are the best, are the safest banks. Their risk to exposures are lesser than the banks on the left. So you can see Equity Bank, United Bank of Africa, Centenary Bank, EFC Post Bank, DFCU, Bank of Baroda, Sanchat, Bank of Africa, KCB, and Housing Finance Bank have been the top performing banks in 2020. Irrespective of the pandemic, these banks have been resilient. These banks have been resilient by optimizing their business models. On top of that, the operational efficiency has been significant. And the banks at the bottom that you can see on your left have struggled with high exposures. Some of these banks took a hit. So in other words, they will perform well this year because they did not restructure. They decided to say, you know what, let's take things head on. Yeah, then some banks have been struggling over time, like Top Finance Bank has been struggling over time. The likes of Cairo, Orient Bank have also been struggling. Orient Bank is transitioning into a merger, so of course it has to write off so many assets, and in that way it has to be able to recover. Ugaford, EcoBank, all those banks are struggling. And if you look at these banks that have improved highly, are the likes of Equity Bank, the likes of Equity Bank, the likes of UBA, DFC have improved from last year's performance. And the banks that have taken a shock are the likes of ABSA. If you look at ABSA, and the likes of Stanbic Bank have also taken a shock, and the likes of Citibank have also taken a shock, and the likes of Opportunity. Tropical Bank was one of the most improved banks. Last year it struggled, but it managed to optimize its business model and recover over 2020, and we see good things going forward.
So thank you very much, members. That is the report we wanted to share with you. We would appreciate to see. We will share with you this slide if you fill our questionnaire, because we have created a comparative analysis of the various banks on their performance against each Camel's item, that is asset quality, capital adequacy, liquidity, sensitivity to market risks, earnings and profitability, and of course management efficiency. So you are able to see a comparative analysis on these banks, and which banks, in our opinion, based on the published information, is doing well compared to the industry. We have as much as possible. This is a position of December 2020. It doesn't mean that it remains like this. It means that as of that time, that is the way we found them, and you'll be able to go through. And we hope that if you have some of the areas you would need the inquiries, we would be happy to provide it. So for each of these, you find that Equity's big doing is asset quality. Because the Equity came in the market aggressively trying to penetrate, obviously it made some decisions, as you do financial depending. There are some of the clients you take on, and that becomes an issue. So that's why you see much as they are doing well, but asset quality is one of the things which is disturbing them. For Centenary Bank, you'll find that what is disturbing them is sensitivity to market risks and to some extent asset quality. And then when it comes to banks like UBA, you find it is earnings and profitability, but also management efficiency. So you'll be able to find all these kind of insights and why our assessment like this. So now we are going to open this to questions. We are going to open this to questions. You'll be able to find all banks like you find it why our earnings and profitability. So now we are going to open this to questions. So you'll be able to find all these kind of insights and why our assessment. So now we are going to open this question like
you find it why our earnings and profitability. So now we are going to open this question. So you will be
I can see a question here saying, may you share this information? May we know the source of information? These are published financial statements. These are the financial statements that have been published and have been verified by Bank of Uganda. So this information is 100% accurate. If you see a figure, that's why I said we shouldn't worry about this. We should just improve on the figures. They're just in ratio format. So, for instance, if you look at the operating income wipeout of impairment, doesn't mean that is your net impairment to operating income. It's what has been wiped out of your operating income. But in essence, these are published financial statements and they are 100% verified. Our open source intelligence is also 100% verified. There are a number of validity tests and back testing that has been done on this, and a number of consultants and experts have also been consulted on these different perspectives, and we have all joined up in a wonderful team and given you these wonderful insights. Thank you very much.
Yes, just to give you confidence is that for information like this, which we include in a public presentation like this, we use what has been published. So every year, banks have been publishing. We get the newspaper publications, and where we can, we go to the different websites of these financial institutions, download these reports which have been published, and we enter them to compile the data bank. And from this data bank, we are then able to analyze a lot of information and trend analysis. Thank you.
Okay, so for Equity, BRAC, and NCBA, yes, they have the highest exposures. So what happened is most of these banks now, for instance, if I talk about Equity, Equity has been lending out excessively. Its agency banking model has ensured they tap into the remotest of villages. But you see, with the more you tap into the remotest of villages, the more exposures you have. So exposures, we look at what we call unexpected loss. So you haven't made the loss, but the fact that the client I'm giving this money out is high risk, I have to put aside a lot of money. So putting aside this a lot of money is what the exposure stands for. So Francis, I've come, I'm maybe married, and I have around maybe 10 wives. I'll have a higher risk exposure. So around 10% of my money should already be put aside. The fact that I already have an increased burden. So that is why the highest exposures are involved and talked about in this. So these are the banks that had high exposures on not only in the net loans, but they had high exposures on their operating income. So it wiped the exposures they had, wiped out most of their operating income. So you may have an exposure of 1%, but that 1% might wipe out around 90% of your income. So you're highly exposed. You've taken up too much risk compared to what you're producing as a bank.
So maybe just to add something now. Okay, it's okay. No worries, it's fine. When you mention banks that are leaders in risk management, what is the basis of your assertion? We showed you the factors which would indicate risk management at a financial institution level. When you are in the lending business, you want to give out credit to the people who are going to pay. So now, if you continuously, that's one of the factors that you give, you do effective assessment of the potential borrower or the person you're lending the money, so that they pay back, and then you make profit on that, and then you can do more lending. Now, that is one of the factors. And if you look at the factors when we share with you the presentation, you are then able to see that those who have managed risk management effectively have been able to report better assets. But also, this also speaks to what are the processes for risk management in terms of, is the process automated? Are you using credit history? For example, if you have been operating as a bank for the last 5 years, you have been giving loans, you classify it by sector and by profile and many other factors. So how do you use this information in addition to the, for example, factors which are introduced by the IFRS 9 to make sure that your lending is most robust and you report a low loss? So those are the factors which we use in terms of asset quality. Thank you. Next one. Mm-hmm.
So to look at the most customer-friendly bank, you can. I'm not going to give you the bank, but if you look at this report, you look at the bank that is giving out, that have a high loan-to-deposit ratio. They are willing to give out as many loans as possible. That is one of those areas. Number two is you look at the banks that are growing deposits very highly. You see, as we showed you earlier, deposits are encouraged by lending practices. So a bank that has grown its deposits very highly, you know, they are so lenient to you that people are saying, let's embrace this lending capacity. Okay, so now from here, you look at the report and you can decide on what exactly is the most lenient bank. I do not want to bias anyone, but you can use the figures to tell yourself this is the most lenient bank.
Yes, but also to add on this, if you look at also in the analysis, we showed a relationship between private sector loans in terms of deposit mobilization. The banks which have lenient lending practices have consistently registered increasing deposits, especially if they are conveniently being provided. So also in terms of customer-friendly bank, you're looking at the channels of the bank and the ease of use of those channels, in addition to what Francis has said. Some banks get funding from their holding companies to avoid being downgraded to new capital requirements. This is why we say when you look at the impact of so many banks likely going to be affected, we think that the central bank may implement this requirement maybe 3 to 5 years time horizon. But because it may be very difficult around these times to basically have people who can give you this kind of funds immediately. Yes, those ones who have holding companies, they will be able to get more new capital, more funds. Those ones who don't have may have to quote new potential investors. But also, you know that it is very bad to look for funding when you are with a gun on the head.
On top of that, I encourage banks to list that are struggling. Yes. So you can list and get funding, cheap funding from the public, and also give them a share of the ownership since they have been your customers for a number of years.
Yeah, that would be a good development. Banks do generic reporting because detail not shown. The accounts show comparative notes to the new accounts, show the detail of items. When we are doing this kind of analysis, in addition, okay. Do you think Bank of Uganda should mandate some local banks to list on the stock exchange? Of course, there are things which are very good. So Bank of Uganda may not mandate because of the license and the law, because their work is to regulate. But any bank which wants to be more local and share and manage some of its risks, I think it is the best practice to list. That's why the market is there. You give a share of the bank to the customers, and if customers they feel like they own a flesh in the bank, I think they are able to support it. And we see, especially in Uganda, it is not good if you have the banking industry highly controlled by foreign owners, because at the end of the day, I don't think the profits they make they will keep it always in the economy. They will take it. In the last year report, we showed you profit repatriation ratio by the banks and the ownership. So listing obviously is the best.
Okay. I've seen another question here that says, for example, the decomposition of systemic shocks and related impacts cannot be published using the published. No, this is not published anywhere internationally. This is the ability to use algorithms to trade, to shake the economy and look at different patterns. There are specific patterns you can pull out from systemic shocks using what we call the market beta. you use the capital asset pricing model. These are models that have been there. The Black Scholes model can also be used in essence to pick out this information from financial statements, and it purely pulls out that information very clearly. It has been well certified in financial engineering. So yeah, there are a number of models, and these kinds of ways you can easily pull out systemic risks. That's why we have continuously advised financial institutions to embrace digital data analytics and training. So in essence, if we can, with even the figures from the financial statements, you can project cash flows. And in cash flows that are projected in enterprise values, if you look at different valuation techniques, we can use that to be able to assess at different aspects of how your earnings are being shocked by the industry. There are different models that we work with. Some of them are binomial, some of them are internal, some of them are as old as the capital asset pricing model. So we join different kinds of models, and then we assess a weighted scale. And this is something we do in financial engineering, and you should be able to embrace it. We encourage you to come to Summit Consulting. We have abundant training in those specific models that can be able to help you push up as much as possible.
Yes, which other question? There is a question which is being asked by Andrew. Maybe you can talk to us. You can unmute Andrew. You ask it so that we can get context to it. Andrew, can you talk to us, Andrew Semaganda, on mobile banking? Can you allow Andrew? Andrew, are you there? Okay, I don't see any questions.
There's another question here. You can see something to do with what is your view on regulating the interest rates?
Okay. Hello.
Okay. Yes.
Yeah. Thank you, Mustafa. Thank you very much. And my question basically is looking at, of course, the competition that is going to ensue going forward between banks and the mobile network operators. My question was, would you recommend banks to become more independent by setting up their networks, mobile networks, in form of masks, or that would be very expensive? Because most banks, I think, they are partnering with the mobile network operators. And of course, the mobile network operators are going to be doing similar business compared to when you compare with what banks do. So that competition, fierce competition, is expected, and we rely on their networks. That was the question. I hope it is clear.
The question is very clear. So when you look at the way markets work, is they optimize synergies and ecosystems. If a bank was to set up masks and run a mobile network, it is a huge capex, 2 huge operations. It is something which does not make value in both the short and long run. Because in the future, we are talking about number portability, where even I don't need to be on the mask of MTN to make a phone call, because I can get one mobile. If, for example, imagine I have an MTN line, and I can load airtime of Airtel on my MTN line and make a call. Now that will be number portability. So if you are going to say I can only keep my market if I'm running the network, then it would make it very strategically wrong and uncompetitive. So we see that banks are going to win because they are going to leverage from the mobile banking ecosystem. Mobile banking ecosystem is leveraging from the open application programming interfaces by the various players. That includes the MNOs, network operators, that is the multinational network operators like MTN or Airtel, and trying to run your own solutions to leverage from their network. Even currently in the world, there is what we call Twilio. Twilio is able to provide mobile connectivity through the satellite. So meaning that in the worst case scenario, if the bank, for example, we do work with Twilio, we use their API when we are using very secure communications, and you don't want maybe them to go through a local telecom company. So if you, instead of setting up a network, you would have to create at least a partnership with Twilio, because Twilio is using satellite, and therefore it is more secure for your traffic. but setting up a network does not make sense. So the bank which is going to win, according to how we see the industry, is that one going to be investing a lot in innovation, investing a lot in picking winners for fintechs in the market, but even more going ahead and providing support for them to grow, and then using those solutions to open their API, which we call the banking value added solutions, and then tapping into the opportunities which are brought about by mobile money. The opportunities which mobile money brings is facilitating payments by far, and they basically, so now that is the area where the banks will win. Now the problem comes if now telecoms get a license, easily become a bank, get a license, and now begin providing loans and accepting deposits. So because they already have a very strong ecosystem of mobile money, it becomes very difficult. So that's why going ahead in fintech is the best strategy for a winning bank, because market flow, they are like water, they flow to the most efficient and the most effective, not the most expensive. Thank you. And I think that's what answers to that. Do you think Bank of Uganda should mandate? Yes.
Yeah, I believe the financial sector is the most developed financial industry. We are already being regulated on essence of reporting. We report generally, and it would be easier for the financial sector to transition fast as other sectors follow suit. So the number of top banks that can list and have evident reserves, much bigger reserves than even banks that have been listed and are available and can easily get themselves going, and also include the many Ugandans in their decision-making processes, since the money that we save with the banks is money that is also used by the banks. So we work as partners, and listing would be the most appropriate option.
Yes, the easiest way of deepening financial literacy, creating an awareness about how markets work, is of course if many organizations list. So because as my colleague has pointed out, banks are already regulated by the central bank, so they pass many ethics for e-listing. So not listing, even if you got 10%, as long as you meet the minimum listing threshold in terms of shares you can offer, I think it is a decision which you cannot say is bad, because it makes you competitive internally, because then you know you are going to be a subject of an eye of so many people, but also it helps you to create brand presence faster, especially if you deliberately do financial engagement. Thank you.
I'm seeing a question here that says, what is your view on regulating interest rates charged by banks with the view of promoting financial inclusion? And this is the last one we're going to take. Yes. These interest rates have not been as efficient in regulating financial inclusion. In other words, what the Bank of Uganda should do is to ease entry of financial institutions into the market, in that the competition itself will be able to push down those interest rates. In most developed markets, it's the competition that has pushed them down. Usually the Bank of Uganda itself borrows from these banks, so there is always a way it will not be able to push them so down while still requesting them to give it its funds to use in certain operations. So the best way possible is to ensure there is increased absorption of banks and increased support for smaller financial institutions that are encouraging financial inclusion. Like the banks we've seen that have over 100% cost to income, loan to deposit ratios, the fact that they have limited reserves, if the bank can keep coming and boosting them, it will pose competition, and the interest rates will eventually subside, and they will be forced to be regulated as much. We've seen the central bank rate hasn't done as much over the years, and the interest rates don't even move as much, and that doesn't make as much impact on that.
So to be very clear is that the Bank of Uganda actually raising the minimum capital threshold is counterintuitive in terms of making financial deepening, because and reducing the overall cost of access to funds, because it is the only competition is the only equalizer in terms of managing interest rates. Now, the more it becomes very difficult for people to enter into that area, the more it becomes very expensive. So thank you very much, members. Maybe this is what do you see the future of banking? We have talked a lot about the future of banking, but most of the time we provide the custom-made slide decks or presentations to inform strategy for banks, for their respective banks, which speak to their own sectors and business models. So some of these conversations, you can always get them in the full report, because we don't have time. We see it is already 1 minute past 1 and we're supposed to be stopping. Then there has been a general shift in actual trend of most variable reported due to COVID restriction lockdown. Therefore, there is need to apply changes in yes, so we will answer, but Stephen, I hope just for purposes of the record, I hope you are comfortable because you are saying our data is not correct. The way we are writing, the way we provide the analysis is different. We don't do absolutes. We use the comparatives and trends.
And on that aspect, if you look at those variables of COVID and area impact, those are called dummy variables. So the outliers are factored into the models. So there's so they are dummied into the models. So literally, what you're looking at there, that data can be used to forecast as many periods as possible, because it has already factored in those shocks. Those systemic shocks have been isolated, and the models are stationary. That's what we call it. Statistically, you say those are stationary models. It's very stationary because we factored out those outliers, and they are very evident. These models are highly validated.
So thank you very much. I will give an opportunity to our partner. If this one, I can see your back, you can say anything, closing remarks. Otherwise, I see my senior, Sejaka. If you want to say something, please talk to us. Otherwise, thanks very much for being part of this engagement. Okay, so thank you very much. You guys. You are muted. Just you are muted. Hey.